African countries are heavily indebted, leading to defaults, most recently Zambia and Ethiopia. These defaults affect the bottom line of development banks such as yours. How exposed is the bank, and what are you going to do about it?
We were very conscientious and responsible as an African multilateral. We agreed long before the other creditors gave debt restructuring to Zambia. We were the first to do it. But what we did is we restructured short-term debt, which was debt arising from letters of credit. And so we restructured. And those letters of credit, normally get paid within 180 days, or some cases it's shorter, some cases it can go up to 360 days to 70 days. But these are normally, for very good reasons, kept out of debt restructuring because countries have to continue doing basic financial operations even during a restructuring process. And so they asked us, could you please reschedule the trade finance credits, the letters of credit that were issued to import essential commodities? And as a responsible lender, as a conscientious multilateral that is specialized in trade finance, we always understood that trade is subject to cash flows, right? So you import on the back of inflows sometimes. You have to export to import, or you need to have remittances, or you have to have an ability to do that. Sometimes your inward cash flows get delayed. It could be due to one or many shocks. And you tend to reschedule because you match your payment schedules with the inflows that they have.
Now, there have been calls by many African leaders, most recently including Kenyan President William Ruto, to have the international financial system overhauled to give reprieve to debt-distressed countries. How would an overhauled system look like, and do you see this offering salvation to the countries under stress?
Well, I think if you look at the situation of a lot of African sovereigns who are in difficult circumstances, they're squeezed right now. There's a funding squeeze. There's multiple things happening, and in the world of finance, you can look at it as a liquidity problem or a solvency problem. If it's a solvency problem, it's a deeper problem, right? And it means you need structural solutions that are very significant. If it's a liquidity problem, it's about enabling short-term funding to move, waiting for the solvency type issues that are not yet there to be averted, right? And so there's a number of ways of looking at it, and I think a lot of African sovereigns have the liquidity issues partly because they have invested heavily in infrastructure. Many of them came out of COVID, of course, and that also had its effects. And so I think this is a slightly different situation if you look at the economic history of the region. I would say, if you just take, you were asking me about this particular case of Kenya. If you look at the amount of assets that have been generated here through debt over the past 10 to 20 years, there's assets to show for all the borrowings, right? There's real assets. These are long-term assets. They're probably worth much more than they were when they were first put up. So these are assets on the balance sheet of countries, right? So that's why it's a liquidity issue. It's not that, these countries are really in a deep, deep black hole. It's not that kind of situation. And I think this is where I think the voices that are really asking for more fair consideration is because, these things don't come out very clearly, right? It's a very blunt approach. Risk turns on or turns off. When it turns off, it doesn't matter. You can be double B, you can be triple B sometimes. Cost of funding goes through the roof, and many people get shut out of markets. So, the system, nobody said it was perfect. I'm not saying it should be perfect, but I'm just saying, there's a lot of room for improvement, and I think there's a lot more fairness. I mean, I think one of the issues that really, really upsets Africans is the cost of financing, right?